Set it and forget it really is summed up in the following expression.
Okay.
It works until it doesn't.
Yeah.
And if the tax code is written in pencil, it's just a matter of time before there's a missed opportunity.
Hey, Mike, a lot of the big, beautiful bill tax changes revolve around the MAGI. What is it, and what do we do about it?
Yeah, MAGI, not to be confused with MAGA,
Oh, yes.
is an old school tax term. It means modified adjusted gross income.
Okay.
Is that not a mouthful?
It is. And so I'm wondering what's the difference between the MAGI, MAGI, and just regular old AGI?
The AGI.
Yeah, the
The
MAGI and the AGI.
So let's add one more in there because you need to have it for context, and
Okay.
that's the provisional income
Ah,
calculation.
okay.
So when you're doing your tax returns, there's an order or a sequence that must be done to figure out what you qualify for and what you don't qualify for. The provisional income, just by quick definition, is for Social Security. The adjusted gross income is really about how much you're going to pay in taxes. The MAGI is the qualifier on which benefits or deductions you may qualify for and which penalties you might pay.
Okay.
Okay. When I say penalties, the easiest one is IRMA. So if you are 65 or older and you're on Medicare and you go above a certain threshold, not according to your adjusted gross income, the amount you pay on taxes, but your modified adjusted gross income, you may pay additional premiums in Medicare. That's what IRMA was intended to do, is say, well, the ultra wealthy can pay more for this, so let's have them pay for it. So the one big beautiful bill, which is the proper name, whether you believe it's big, whether you believe it's beautiful or not. It's 900 pages. I went through it personally. It was big. Whether it's beautiful or not, that's up for you to decide. But the many of the tax breaks and changes are only for certain people. And that is so important. And so that's why right now a lot of people are saying, well, what's the MAGI? What's the modified adjusted gross income? How does that qualify? How does that quantify? How do you run this calculation? Now they're starting to pay more attention to tax planning. And what a wonderful thing. I'm not saying that we all should become accountants. I'm not saying that anyone's going to enjoy diving into their taxes, but you have thousands, if not tens of thousands of potential savings if you understand how to do tax planning.
Yeah, and so the people who would save are like retired folks? Is that really when we...
Anyone.
Oh, anyone.
Yeah, good clarification. Understanding your adjusted gross income and your modified adjusted gross income as you're working, you need to understand where are you going so that once you get there, you understand how to then maintain your retirement. Many times people will spend their working life saving in a certain way and not realize that they're creating problems for themselves later on in life. So you want to pay attention to these things as you're working and once you retire. It's a coordinated effort.
That's
Yeah,
good.
So
Yeah.
great clarification. So just real quick, going back to provisional income, the purpose of it is to figure out, is your Social Security going to be taxed at 0%, 50%, or 85%? And the reason why I'm starting here is it's kind of a simpler version of the modified adjusted gross income. So here's how the provisional income calculation works. You're going to take half of your Social Security, okay? So whatever that amount is, divide it by 2, plus all of your taxable income. So think of W-2, 1099, your IRA distributions. That's pretty easy to get that part of it. And then you have to put back in your tax exempt, if you will, income, not your Roth, but think of like your municipal bond interest, things like that.
Okay, got it.
You put that back in there, you add it all up, and that will determine your Social Security calculation. Now, that's the first thing that's done. When you get to the modified adjusted gross income, what you're doing is you're taking your total taxable amount, your adjusted gross income, and I apologize for all the semantics here. I know it's dense, but you need to know this. There are thousands of dollars on the line every year if you don't get this and don't plan accordingly. So you've got your adjusted gross income, and then what you do is you then add back in the amount that you put into your IRA that you've deferred. So you've let's say you took $160,000 income as a salary, but you put $20,000 in as in your IRA, so you're not paying taxes on that. You've deferred that for a period of time. So your adjusted gross income would be $140,000. So $160,000 take it down by 20,000 because that's what went in your 401k. Now you're at 140,000. Are you with me?
Yep, I follow that.
Okay. The modified adjusted gross income would say, well, that's you got to take that back in for this calculation, and now it's 160,000.
Oh,
So it's a way to prevent wealthier individuals who are deferring taxes to say, well, how much really is at stake here, and how would that actually would you qualify for certain benefits or not? So for right now, you've got one of the new things. It's the 65 plus additional standard deduction that's going to be happening for the next 5 years. Okay,
so this is new. What you
this
just
is
mentioned.
new for the one big beautiful bill.
Okay.
And if you're 65 years or older for the next couple of years, about 5 years till 2031, I believe, you can deduct 6,000 if you are single or 12,000 if you are married, in addition to your standard deduction. They did this really to try and help more people not pay taxes on their Social Security because they couldn't make Social Security tax free. I know people have said, well, Trump said or so-and-so said they made Social Security tax free. They didn't. They made Social Security tax free for more people, but not for all people.
Okay.
And so with the because they're doing this based on your modified adjusted gross income, many people that are wealthier just are still going to pay taxes on their Social Security. Does that make sense?
Yeah.
Kind of how this works out.
Yeah, I think I followed. Yeah, it's just it's expanding the amount of people. They're casting a wider net of who can get Social Security tax free. So.
Yeah, it's more technical to qualify for these benefits. So for a married couple, if your modified adjusted gross income is 150,000 or less, okay? Modified adjusted gross income, not your adjusted gross income,
Yes.
your modified. So you've got to include the municipal bond interest and all the other things that could be added back in there.
Okay.
You know, are you deducting by contributing to an IRA because you're still working, whatever it is. You got to add that all back in there. If it's $150,000 or less, then yeah, you get to take your $30-some thousand standard deduction and then add another $12,000 in the standard deduction. Plus, there's the other addition bonus of like a couple $1,000s. There's a lot of additional deductions that are standard. It's very difficult for people to itemize their deductions right now, but you need to qualify for it based on that modified adjusted gross income. Now, what happens if your modified adjusted gross income is like 160,000 or 170,000? It phases out. So you might not get all of this new senior deduction that's for the next 5 years, but maybe you get part of it. The rule of thumb is if I remember right in the calculations, 195,000 or less for your modified adjusted gross income, you should be able to deduct something from this new benefit.
Okay. What if you're somebody who doesn't have a bunch of like income from other sources? What if you're just solely relying on Social Security as your income right now?
Yeah.
This probably doesn't change much for you? Or?
Doesn't change a thing.
Okay.
Yeah. It's for people that typically are wealthier, that have more moving parts in their plan. They are the ones that have to pay attention to. But if you're married and your total income is, let's say, 120,000 or less, so 10,000 net a month, well, somewhere around there, there's a good chance that you can kind of be in this threshold and maximize the full benefit. Okay, it's going to depend on your IRA to Roth conversions. It's going to depend on your income sources, and is it all from your IRA or is it not? Did you take the pension? Do you have Social Security? And so these things are going to matter. This is one of the main reasons why I have shouted from the rooftops, so to speak, of saying don't lock yourself up into a fixed income retirement plan.
Yeah, tell us why.
You want flexibility.
Okay.
So for all the people that have their Social Security, maybe they have a pension, maybe they have an annuity, but it's underneath, let's say 70,000 in total. They have enough flexibility to manipulate their situation to potentially take advantage of these different new opportunities, because the tax code is written in pencil. Unless you can adjust your income, your plan, your income sources, your conversions, all of the above, unless you can really adjust that, you could have ended up opting out and making it impossible for you to really enjoy these benefits. Rigidity and fixed income, if that's all you're doing and you're a higher net worth individual, you could be really missing out on these opportunities because you just looked for that oversimplified set it and forget it retirement plan.
Yeah,
There's a cost.
Set it and forget it may have worked in times past, but are we beyond that, or did it never? Has it never been a good idea?
Set it and forget it really is summed up in the following expression.
Okay.
It works until it doesn't.
Yeah.
And if the tax code is written in pencil, it's just a matter of time before there's a missed opportunity.
Right.
It's about balance. It's about understanding, maybe you want your basis to be covered. You got your Social Security, and maybe, I wrote the whole book, How to Retire on Time, which, shameless plug, you can download it still for free at the time that's recording this podcast and on the radio show. You can still download it for free, retireontime.com. But it's an argument against locking all of your assets up into a lifetime income stream and that set it, forget it plan. And the reason is there's a lot of legacy planning and tax planning that can be done along the way without not necessarily taking more risk. It's just a different path to plan your retirement. There's 10 ways you can take income in retirement. The annuity, lifetime income annuity option is one of the 10 different ways. You just need to understand what's rigid, what do you not have negotiating power over, and what can you adjust so that you maximize these efficiencies, so that you maximize the opportunities ahead of us. Because I can tell you right now, even though the current law says that these tax brackets are permanent, they're permanent until they're not. It doesn't matter until it matters. That's just how it is.
Yeah.
So it creates pause for me when someone says, I just want to buy a bunch of annuities, turn on income, and then that's it.
And so we talked a lot about MAGI, and other kinds of income.
Provi, provisional income.
Provi, yeah, I haven't heard that one.
So just made that up.
You heard it here first. So are people going to have to get an accountant to do all this? Will TurboTax be able to figure this out?
That's actually a really good question. TurboTax and TaxSlayer, by the way, which is an alternative to TurboTax, and a number of these other softwares that you can buy. Tax Act.
We could list a lot.
About 50, 60, 70 bucks or so, do it yourself. They are incredible softwares. I do not want to diminish anyone from using them. Love them. A lot of our clients use them. They will get the calculations perfect. I can't guarantee their services, but they're really, really good. Like you're going to get that tax return right. The problem is, when do you use it? You're using it after your tax year has finished. You're just reporting what happened.
Good point.
Any change you make in your tax return, if you're doing tax planning and you're being proactive, you make one change, it affects 5 to 7 other parts of your 1040. And so, yes, you can file your taxes and it will show you the benefits and things like that of all these things. They're not going to miss that typically. But if you want to be proactive, then it's the year before you're saying, here's the tax environment. So in November of this year or in September of this year, you're saying, next year, how am I going to take my income? How am I going to do my IRA to Roth conversions? How am I going to maintain my cash flow, plan for the dividends I expect, and so on, so that I can take advantage of the different opportunities proactively, not reactively. The problem is people expect their CPAs to fix and do this tax planning after it's already happened. I'm sorry, it's done. It's set in stone. You're not going back in history. The time machine's not been invented to refix whatever these issues. You've got to be proactive, and most people aren't paying $2,000, $3,000, $4,000 a year for tax planning simulation software to be able to do that. That's why people come to us. That's why people will say, well, hey, Mike, I want to be proactive in this. I want to understand, how do I minimize my overall taxes? They realize that maybe their entire strategy is flawed because they're going too fast. Now that they realize that the tax rates are permanent, they've got more breathing room. Now that they realize that the RMDs won't start till 75, maybe they're going to take a step back and say, hey, let's take a look at this and be more strategic about how do we keep more of our assets, how do we minimize our tax burdens based on effective tax rates, and how do we weave in the various seasons, so for the next 5 years, and then 5 years after that, and then 5 years after that, to be able to take advantage of the tax legislation, the new tax laws that evolve over time so that you're able to keep more of your money, pay less in taxes, and live a better life. That takes proactive effort. And if you expect your CPA, your enrolled agent, or the softwares like TurboTax to do that, you're asking an impossible situation. It can't happen. Hey, thanks for watching this video. Make sure that you like and subscribe first, and then go to www.retireontime.com to grab a copy of my book, How to Retire on Time, take a few courses about retirement, join my newsletter, and so much more. Now, if you want to work with one of our advisors here at Kedrick Wealth, who can help you put together a retirement plan that's designed to last longer than you, just click the button, Get Started. Everything we do is intended to help you retire on time. We hope you enjoy, and we'll see you in the next show.